Hello, everyone, and welcome back to Money and Banking. Today, we're moving into Chapter 12, which is really kind of a theoretical overview of financial crises. We'll take a specific kind of model of the development of financial crises, and we will apply it to at least two cases in the domestic sphere: the Great Depression and the financial crisis of 2007, 2008. I will note that many of the things that we will be learning in the abstract here, of course, can be applied to crises in other countries, namely a fascinating set of crises, which I have spent a lot of time focusing on, which is financial crises in emerging markets, which often come in the form of either a sovereign debt crisis or a currency crisis. And if we have time, we'll get into that. But let's stick with the brass tacks of Chapter 12 to begin with. Let's take a brief look at the mother of all financial crises, the Great Depression. How did a financial crisis unfold during the Great Depression, and how did it lead to the worst economic downturn in U.S. history? Well, the short story is that the event was brought on by a stock market crash, subsequent banking panics, continued decline in stock prices, and deep debt deflation. So the Great Depression is really kind of marked from 1929. Prior to 1929, we'd been operating in a period of time known as the Roaring Twenties, where not only do we associate this with sort of flappers and Fitzgerald and lavish parties and decadent parties and so on and so forth. This is associated with a general sense of growing wealth and growing prosperity among many of the market participants, right? And this was in part backed by a stock market price increase, which sustained through the 20s, and that, in historical perspective was obviously a bubble, but from the perspective of people who were living through the 1920s, they deluded themselves into thinking that what goes up will never come down. So as stock market prices kept rising and rising, individuals thought, well, I better buy now because I don't want to miss out on future price increases of my assets. And so there was this wild frenzy that prices would always continue to go up, which caused individuals to need to get into the market to take advantage of those price asset increases. And this led to excessive buying and excessive buying and excessive frenzy that fed the market boom. But in 1999, that stock market collapsed, losing about 90% of its value. It absolutely imploded. So what other wealth or assets you had put into the stock market in order to acquire profits from ever-increasing stock prices, well, your asset side of the balance sheet just evaporated. 90% of it just disappeared. And so we can see that stock market crash 1929 to 1932 at its low, an absolute plummeting of asset price values in the stock market. Now, if you can imagine, this ripples through, right? This ripples through the system. So if you had taken, many of your assets and rolled them onto the stock market, you were now bankrupt. If you were an institution that had taken its assets and rolled them on the stock market, you were now essentially bankrupt. If you were a bank that had taken depositors' money and rather than, loaning it out to safe entities like small businesses or farm loans or something else, if you had taken those deposits and put them on the stock market to take advantage of the astronomical profits therein, you now were an insolvent bank where your assets disappeared and your liabilities stayed the same. And so you would have to now default on your shareholders, default on your depositors, default on your liabilities. And so that stock market crash creates a balance sheet shift from solvent and profitable to insolvent. Insolvent being when your assets no longer match your liabilities. And this leads to uncertainty. It leads to this notion where I do not know whether my bank has gambled its money on the stock market or it has not. I do not know whether or not my company or my individual borrower had taken money that was borrowed and put it on the stock market and now is going to default on me or not. So we see this asymmetric information where we don't know the balance sheets of many of these financial entities, right? And then we see uncertainty increase and fear increase as well, right? An index of this uncertainty and fear, the credit spreads during the Great Depression. You can see that as the market collapses, we start to see credit spreads climb dramatically. So this is based off of the spread off of the Treasury, and this reflects uncertainty in financial markets. And the uncertainty is increasing, and we're seeing that on the spread between corporate bonds and low-risk Treasury bonds, right? We're wondering whether or not these corporations have lost tremendous assets, they're having problems, and they're not going to be able to pay their debt. Therefore, their risk premium shoots through the roof because of course, uncertainty, that is stemming from the problem. Now, this is a sort of short story. It tells you what's happening, right? Banks don't want to lend because they don't know if the borrowers are any good or not. People who are having their money in banks are very curious as to whether or not the bank is solvent or insolvent. And this created a lot of runs on banks. And one of the interesting things here is the anatomy of a bank run. I mean, you can imagine your bank having taken your deposits and made good, safe loans with them. So not one of these high risk-taking, unscrupulous banks that gambled their depositors' money on the stock market, but a very responsible, very conservative sort of bank, right? You don't know whether or not that bank gambled your money on the stock market or not, but you know that if you don't go take your money out of the bank quickly, that there will be no money in the bank because everyone else will go to the bank and exhaust the bank's reserves. So we can talk about that if you like, right? So you want to be the first one that gets to the bank to exhaust the amount of money that's in the bank vault. And people that come later to the bank will have to go away with their hat in their hand because the bank will say, look, we only had so much money in the vault. The rest of the money is out in these loans, and it's getting paid in. It's all of our borrowers are paying principal and interest, but it's coming in at a trickle. And we can't give you your entire life savings right now. We'd have to wait months to be able to accumulate that, right? All of our reserves in the bank vault have been exhausted by now. So you don't want to be the second or third individual at the bank. You want to be the first individual at the bank, which causes you to walk very briskly to the bank. But if you notice that someone else who's also a client of the bank is walking ahead of you to the bank very briskly, then you're going to step into a bit of a skip or a trot. And as you get ahead of them, of course, they're going to say, I have to be the first one at the bank to exhaust the bank reserve. They start galloping, and then you start running. And what we have is a bank run trying to exhaust the vault cash before the bank has to become illiquid and can no longer satisfy its withdrawal requests. So during the Great Depression, we saw initially banking crises because banks had gambled money on the stock market, lost their assets, and become insolvent. But then we saw a second wave of banking crisis in the United States as uncertainty and fear led to bank runs that collapsed otherwise healthy, solvent banks. And as the banking system collapsed, of course, the money supply in the economy collapsed, all of the lending collapsed, and then economic activity collapsed as well, pushing unemployment rates up to 25%. That's a short synopsis of the Great Depression. The global financial crisis of 2007, 2009. Some of the causes of this financial crisis were financial innovation in mortgage markets. What we had done is we had this issue of subprime mortgages, right? Giving mortgages to individuals who had less than outstanding credit. And these subprime mortgages were very, very risky securities. So in order to have an explosion in the mortgage market, certainly the explosion that we saw, we needed some sort of financial innovation to deal with these low-quality borrowers. And the financial innovation that we used to deal with servicing these low-quality borrowers was something called mortgage-backed securities. These are securities, assets that can be bought and sold, which are backed by ownership of homes, right, by mortgages. We took these mortgage-backed securities, right, these securities or assets that were backed by some real capital, mortgages, right? And we turned them into collateralized debt obligations. So essentially what we did was we packaged them all together and created these CDOs, the backing of which was an asset like a mortgage. Now keep in mind that as home prices started to skyrocket out of touch with the reality, the hypothetical value of the collateral attached to the CDOs was drastically overstated relative to their real value. The idea here was that we were able to create a financial innovation, a mortgage-backed security, a collateralized debt obligation that allowed us to package all these subprime mortgages together, and in packaging them, arguably reduce the risk associated with them. So whereas lending to an individual subprime borrower might be somewhat risky, lending to 50 or 100 or 1,000 of them would be less risky. The idea behind that is that you're diversifying your risk across many participants. So you've got 100 subprime borrowers. It may be extremely likely that one or two of them default this month, but it's extremely unlikely that all of them default this month. So that there is a portion of the mortgage payments which is very stable, and this is again arguably, right, in terms of statistical reasoning and mathematical theory, there's a portion of the mortgage payments that are always going to be paid in. Maybe 75% of them will always get paid in. And then 25% of them will be somewhat risky, sometimes paying, sometimes not, And so you divide up the income flows in this way, creating a very stable and safe revenue stream for the security. At least that's what the innovative hypothesis was behind collateralized debt obligations. Well, this in part allows for an explosion of lending, right? We now have this safe way to create mortgages, and so now we can create more mortgages to this market, this subprime market. This led to an increase in liquidity from cash flows surging into the United States and the development of the subprime mortgage market, fueling housing demand and fueling home prices. Added to this explosion of lending was a new sort of agency problem that arose. And it arose when it became possible again through these mortgage-backed securities to not only issue mortgages and to create these debt obligations, but then rather than holding the mortgage on your books, right, you would then sell it off as a security to financial markets. So this creates a perversion, right? An important perversion in the way that the market worked. In historical traditional terms, what would happen is a bank would follow something called the 363 model. They would borrow money at 3%, lend it at 6%, and be on the golf course at 3 p.m., right? You're borrowing money at 3%, you're lending it out at 6%, your profit margin is 3%, right? Now, in this sort of model, right, when you make a loan to an entity as a bank, you look at that entity, you assess the likelihood that they're going to pay you back, you assess their credit worthiness, and every month that entity pays you back. And because they're paying you back, because they're an asset on your balance sheet, you go through a lot of due diligence in making sure that the entity is a good borrower, because you don't want them to default on you, right? It could cause you to go insolvent. But what happened with this financial innovation of the mortgage-backed security meant that banks would originate the mortgage, they would lend the money out, but then they would package the mortgage in a security and sell that off to other financial institutions like pension funds and investment banks and so on and so forth. So they switched to a model of originate and distribute, right? Where they would make the mortgage, cash in the bonus, and then cash in the money from selling the mortgage-backed security, which meant that they no longer held the asset on their balance sheet. And since they no longer held the asset on their balance sheet, they could issue another mortgage and another mortgage and another mortgage. And their profit was being made by issuing mortgages, packaging them in securities, and then selling that risk off to other parties, right? So if I'm selling the mortgage off to another party, I care less and less about the quality of the borrower because I'm not exposed to the risk. Whoever I sell the mortgage-backed security is exposed to the risk. So now we've got an issue where the mortgage broker is not looking after the investor's interests because they're making loans to very, very low quality borrowers. Now, additionally, there was an agency problem because the people who were borrowing the money had little incentive to disclose information about their ability to pay. They'd walk in and say, hey, I get a Social Security check for $500 a month, and the mortgage broker would say, you qualified for $1,000,000 home. And the mortgage broker doesn't care because he sells that loan off in a mortgage-backed security to another investor. So these perversions caused us to select for increasingly risky borrowers, thereby increasing the fragility of the quality of these assets. And at the same time, through financing all of these mortgages, there became a flood of demand for homes, and it drastically pushed up home prices, leading to overvaluation of homes as well. And those home prices would collapse when this market collapsed as well. Now, again, we had some issue here with the provision of information. Commercial and investment banks who were buying up these mortgage-backed security, well, they looked at rating agencies, and the rating agencies, well, they rated these mortgage-backed securities as being safe, extremely safe, in fact, AAA rated, right? So the sellers of the mortgage-backed securities were paying the rating agencies. The rating agencies were saying these mortgage-backed securities are cherries, right? And then this excessive risk was not being noticed, it was not being monitored, and it was being spread throughout the global financial system. We could go into more detail about the mechanics of a collateralized debt obligation. We should just barely touch on it. The creation of a collateralized debt obligation involves a corporate entity called a special purpose vehicle that buys a collection of assets such as corporate bonds and loans, mortgage-backed securities, commercial real estate bonds, and mortgage-backed securities. This special purpose vehicle then separates the payment streams or cash flows into tranches. So, we're talking about, say, 1,000 mortgages, and rather than owning an individual payment from an individual person, you own a percentage of the money that is paid in by all of the persons, right? This allows you to create revenue streams that are going to be modeled as being AAA rated. The highest rated tranches, referred to as super senior tranches, are the ones that are paid off first, and so they have the least risk, right? The lowest tranches of the CDO are the equity tranche, and it's the first set of cash flows that are not paid out if some proportion of the underlying assets goes into defaults or stops making payments. So, you take portions of the income stream that is flooding into this, and the super senior tranches are the ones that will be paid off first, and then so on and so on and so forth to higher and higher levels of risk that you can then part out and sell as different securities. But the statistics and the math on these CDOs was wrong, right? Again, remember, the general idea is that if you've got 100 borrowers, the likelihood that 5 of them don't pay is very high. So these are low quality tranches. But the likelihood that 80% of them are paying at any given time is extremely, extremely high. So you can create a very safe income. The problem was that those probability assignments were not based off of any historical reality. They were based off of sort of theory, if you will. And the problem was that all of the borrowers were correlated, right? Their likelihood of default was correlated. And we saw this in the effects of the 2007-2009 financial crisis. After the sustained boom in housing prices, they began a long decline in 2006. The decline in housing prices contributed to a rise in defaults on mortgages and a deterioration of the balance sheet of financial institutions. So everyone started defaulting together as this sort of avalanche started to occur. And this development, in turn, created a run on the shadow banking industry, sort of like the bank runs that we would have seen during the Great Depression. This spread globally. The signs of and this, of course, was a sign of just how integrated we'd become as a global financial market, that a housing crisis in the United States could lead to a global financial collapse. TED spreads, 3-month interest rates on Eurodollar minus 3-month Treasury bill rates, increased 40 basis points to almost 240 basis points by August 2006. As we became aware that these CDOs and mortgage-backed securities were worth far less than we had valued them at, we had to write down the assets on the balance sheet of anybody that was holding these things. We thought they were gold, and now we wake up and realize they are worthless. Banks that were holding these were either going to see their balance sheet shifts into insolvency, or they were going to have to sell them off. And as they started selling them off, the price just kept declining and declining and declining and declining as other entities became aware that these were not AAA quality, but were in fact worthless. And so you had a selling market with no buyers, causing there to be no asset price stop to how far the decline would go. This leads to, again, balance sheet effects that lead many, many high-profile, long-standing firms to collapse, such as Bear Stearns or the government entity Fannie Mae and Freddie Mac. You may also remember the Lehman Brothers, Merrill Lynch, AGI, and other mutual funds like Washington Mutual Fund going into collapse as well. In order to prevent these large institutions from collapsing and this collapse leading to a total market seizing, the House of Representatives and the government ended up eventually stepping in. But they were sort of slow to do so, as government action oftentimes is, and the Federal Reserve was able to do a lot more quickly with their TARP program than the House of Representatives. The House of Representatives voted down a $700 billion bailout package on September 29th, 2008. And just a few days later, after the stock market had collapsed in response to their failure to vote a bailout package, well, the stock market collapsed, and of course the House got back together on October 3rd and passed the bill. Congress and eventually ended up approving $787 billion in economic stimulus by February of 2009, and it was an all-hands-on-deck affair with the Treasury as well as the Federal Reserve doing things that had never been done before, that were completely unprecedented, in an attempt to stabilize the banking system and stave off what would have been a larger economic collapse than the Great Depression itself. But government action in the form of Keynesian-style policies to stabilize the system averted a collapse that was worse than the Great Depression. And yet still, the crisis was a prolonged and brutal one. Here's a look at the housing prices. Again, we see a bubble in the housing prices, individuals thinking that what goes up must never come down, sort of like before the Great Depression, and then the rude awakening in 2006 that led to balance sheet effects and write-down effects that lead to a seizing of financial transactions. The stock prices that we're looking at, of course, we saw a boom in stock prices together with a boom in housing prices and a reckoning in late 2007 as we became aware of the widespread problems that would be caused by this deepening financial crisis. As you will have noted, in the collapse of the stock market in 1929, the stock market lost 90% of its value, and in the stock market collapse of 2008, it lost 50% of its overall value, a huge implosion. Now, some individuals argue that the Federal Reserve was to blame because interest rates had been kept very, very low since 9/11, possibly stimulating overlending and a credit boom in housing, as well as asset price increases in the stock market. But one must also keep in mind that loose monetary policy, while contributing somewhat to the credit boom, could not have had the widespread effect that it did have unless there would have been deregulation of financial markets and financial innovation in the form of allowing retail banks to generate securities and sell them off to investment banks that had previously been illegal and was made legal in deregulation of the financial markets. So there's a lot to this, if you will. And so all of the components had to be in play for the crisis to unfold as it did, which, Chairman Ben Bernanke pointed out. He said loose money could have never done this without, deregulation of financial institutions, allowing retail banks to issue securities to investment banks, and financial innovation, as well as the rating agencies and their provision of low-quality information, essentially marking these assets as safe when, of course, they were not. as a fallout of the crises with governments needing to provide stimulus as well as bail out banks, we saw that sovereign or government debt levels started to increase. And so we saw an increase in budget deficits that followed the financial crash of 2007 2009. This led to fears of government defaults and a surge in interest rates, which led to the precipice of a sovereign debt crisis for many countries in Europe. It began in Greece, it moved to Ireland, Portugal, Spain, and Italy were also notorious in this regard, having budget deficits that were astronomical, and them thinking they would either have to default on their budget deficits or devalue their currencies. Now, if you are keeping in mind that at this period of time, all of these countries, as they are now, were members of the euro, so they did not have their own currencies. They could not devalue their own currencies, which would leave them in a position of either defaulting on their debt or leaving the eurozone, effectively leading to a collapse of that monetary project. And so the European crises through debt and potential currency crises was one direct manifestation of the global financial crisis in 2007 through 2009. At the height of the crises, the stock market crash gathered pace in the fall of 2008. Within the week beginning October 6th, 2008, it was showing the worst weekly decline in U.S. history. We saw surging interest rates faced by borrowers. This led to sharp declines in investment, consumer spending, and sharp declines in aggregate demand, further weakening the economy and creating problems with unemployment on Main Street. The unemployment rate shot up, going over 10% in late 2009. This was the worst economic contraction since World War II. Here we see credit spreads responding, this risk measure again, shooting up. We could continue with this, but I think the lecture is running a little long, and so we're going to cut it off here and come back later with either a part 2 or we'll move on to our next chapter. Please, again, make sure that you fully kind of understand these terms and topics, such as adverse selection, information asymmetry, principal agent problems, moral hazard, too big to fail, and try to keep them in context with the brief overview that we did of 2 major crises that each among themselves can require reams of dissertation on. All right. Well, thank you for your time, and I hope you enjoyed the lecture. We'll see you again next time.